Hello. Welcome on board FM Financial Management. I'm Rashaad Hussain, your expert tutor for FM. In your opinion, which FM area is more difficult? There are many, but the one that is covered in this video is lease versus buy. Today, we will dissect this topic and get insights on how to approach and solve lease versus buy question. It covers the syllabus area of D investment appraisal. Now, at first, it may seem difficult, but I assure you by the end of this video, you'll be able to tackle it like a pro. This area relates to the Study Hub Chapter 6 application of discounted cash flow techniques. Before we move into the illustration, let's go through the concept. This area of investment appraisal, the topic that we are dealing right now is that of the leasing. In leasing, there are two parties to the leasing. One, which is the lessee, the person who uses the asset, and the other party is the lessor, the person who buys the asset and gives it on lease. Lessor is the person who does the business of leasing. He buys the asset, he maintains the asset, he gets rent. So, what are all the cash flows that are going to be relevant as far as the lessor is concerned? Lessor is going to buy the asset, so there's going to be a negative capital cost. Since he owns the asset, when the asset is sold, the scrap value or disposal value is going to receive the scrap value or the disposal value. And on that asset, since the asset belongs to him, he is going to have the tax savings or the tax benefit on tax allowable depreciation, TAD, tax allowable depreciation. He's going to receive the rental income, so he's going to have the lease rental receipts, and on that lease rental receipt, it's an income, he's going to incur what is it, the tax expense on the rent. The asset belongs to him, he'll be maintaining the asset, and for that maintenance is going to incur the maintenance cost. And maintenance cost being an expense, we are going to have what is it, tax savings or tax benefit on maintenance cost. All these cash flows taken on their respective year and finding out the NPV. If this NPV turns to be positive, we shall accept the project, and if this NPV is negative, we shall reject the project. Now, the other perspective of the lessee, the person who uses the asset, has always got two options. One option, he can lease the asset. The other option, he can buy the asset. Now, a person who leases, who takes it on rent, is not going to pay the capital cost. He is not going to get the disposal value. The asset does not belong to him. So, he also doesn't get the tax savings on depreciation. But instead of the lease rental receipt, this person, the lessee, is going to pay the rent. So it's going to be, what is it? Lease rental payment. It's going to be lease rental payment. And on that lease rental payment, it's an expense. So we're going to have, what is it? Tax benefit or tax savings on the rent. So these cash flows, when we find out the present value of these cash flows are called as present value of leasing option. It's called as present value of leasing option. On the other hand, when we buy the asset, we'll have to spend for the asset, we'll have the capital cost. Yes, the asset belongs to us. So obviously the disposal value or the scrap value, disposal value or the scrap value will belong to us. The asset belongs to us, so obviously we are going to receive its tax savings on depreciation, tax savings on TAD, tax allowable depreciation. Lease rental, no, we are not paying it, we are not receiving it, we have bought it, we are going to use it ourselves. So no lease rental, no tax expense on lease rental. The asset belongs to us, and obviously, and hence, we'll have to pay the maintenance cost of it. Maintenance cost of it. And on that maintenance cost, we'll have, what is it, tax savings on maintenance cost. All these cash flows taken at their respective year, we'll find out the present value, and this present value is called as present value of buying option. Now, how do we decide whether we should lease or buy the asset? We need to compare between two present values. Which two present value? Present value of leasing option versus present value of buying option. Both of these present values are negative. Why are they negative? Because they are cost. So we are supposed to go for the lowest cost. The lowest cost option shall be recommended. Now let's dive into an illustration to grasp this concept better. Let's go through this exercise step by step and get a clear understanding of how to analyze lease versus buy scenarios effectively. Reading the illustration. Prime company is a small company that is finding it difficult to raise funds to acquire a new machine. The machine could cost $5 million and would have an economic life of 4 years. Prime company can claim tax allowable depreciation of 25% per annum on a reducing balance basis on the new machine. The company pays corporate tax at an annual rate of 30%, and all tax liabilities are paid 1 year in arrears. It intends to finance the new machine by a means of a 4 year fixed interest loan at a pre tax cost of 11.4% per annum. If the machine is acquired, then maintenance cost of $100,000 per year will be incurred. As an alternative, a leasing company has proposed to lease the machine for 4 years at 1.5 million per year payable in advance. Scrap value of the machine under each financing alternative will be zero. Required. Evaluate the two options and advise which option is more attractive in financial terms to prime company. I'll highly recommend you to pause it here, stop, go attempt this question, and then get back to compare your answers. Let's move towards solving this using the blank workspace on the CB platform to solve this illustration. Now we need to compare between two options, the options of leasing and buying in the perspective of the lessee. The easy point to start would be to start off with the leasing option. So let's have the leasing option. Let's compare the leasing option. So we are going to require, the project has got how many years? It got 4 years. And since the rent is in advance, we'll have to start from 0, 1, 2, 3, 4, and 5. And the first cash flow is going to be that of the lease rental payment. Lease rental payment. How much is the lease rental payment? From the question, you can see it to be 1.5 million for 4 years at 1.5 million per year. And how much is it? 1.5 million. 1.5 million for 4 years. This lease rental adjustment is wrong. This is not how it is supposed to be placed. It is supposed to be placed in advance. So first year lease rent shall be paid in year 0. Second year lease rental shall be paid in 1. Third shall be paid in 2. Fourth shall be paid in 3. So the lease rentals shall be placed in advance. And then we have got tax benefit on the rent. And this tax benefit on rent being in arrears and at the rate of tax at the rate of 20% is going to give me 4,50,000 or 450,000. This 450,000 in arrears, tax in arrears, is 1, 2, 3, 4 is a wrong adjustment. It's supposed to be placed in arrears. Year 1 rent being paid in the year 0, but its tax is not going to be in 1, but the tax is going to be in at year 2. So it's going to be year 1 rent paid in 0, year 1 tax paid in arrears, which is going to be 2. So these are the cash flows or net cash flows, getting the net cash flows. We've got the net cash flows, using these net cash flows to calculate the present value of leasing alternative option, which is equal to NPV. What rate is it? Oh, the rate is not calculated. We have got to calculate the rate. So let's put that on hold. First adjustment that we need to do here is the rate calculation. So let's go. The discount rate post tax is equal to pre-tax rate into 1 minus tax. How much is the pre-tax rate? The pre-tax rate is 11.4 percentage into 1 minus 0.30 percentage, and that's approximately, we can round it to 8 percentage. So here the present value of leasing option equal to NPV. At what rate are we doing it? 8 percentage, comma. The cash flows that are supposed to be selected when you calculate the present value, it should not include year 0. It should be from year 1 onwards, 1, 2, 3, 4, 5, close bracket. Then after closing the bracket, you can add year 0 to get the present value of leasing option. The present value of leasing option is 3,985,593. Now, in order to calculate the present value of buying option, we need to find out the tax savings on depreciation or the tax benefit calculation of tax benefit on taxable depreciation, which is at 25 percentage. And let us calculate here. We've got the opening balance of the asset. We need to calculate tax allowable depreciation at 25 percentage. We need to get the tax benefit from it. And finally, since it is in arrears, let's have the impact here. Let's have the impact here. So year 1, 2, 3, 4, and the opening balance of the asset is 500,000, 5 million. And on that 5 million, how much is the depreciation? 25 percentage. Depreciation 25 percentage. Taking the opening balance of the next year, which is going to be opening balance of the first year, minus depreciation is going to be the opening balance of the second year, taking up all the opening balance. And the final year, we assume balancing allowance to be done. Since the scrap value is 0, the asset shall be fully depreciated in the final year of operation, taking 30 percentage as tax benefit on tax allowable depreciation. And further, as specified in the question, the impact is going to be in arrears, which is going to be 2, 3, 4, and 5. Now we are done with the calculation, the working note for calculation of tax benefit on tax allowable depreciation. I'm going to use this information in order to find out the present value of buying option. Present value of buying option. Copying the years. What all cost? If you get back to that template, if you get back to those steps which we've already written on the screen, what is the first thing that we need to ensure that we are done with? We need to pick up the capital cost. How much is the capital cost? The capital cost is going to be 5 million. And then we've got the tax benefit on tax allowable depreciation, which is calculated as per working note 1, and picking up all those respective tax benefits. And once we are done with the tax benefit, we need to consider the maintenance cost, which is going to be negative, and it's hundred thousands for hundred thousands for 4 years. And on those maintenance costs, we're going to have tax benefit of maintenance cost, which is going to be in arrears at the rate of 30% from 2 to 5. And finally, we've got all the cash flows, the net cash flows, taking the sum equal to sum, selecting all the cash flows. We've got beautifully got the cash flows, and now we're finding the present value of the buying option. Saving time by copying the formula. Now, present value of the buying option is 4,108,715. What about the present value of the leasing option? Present value of leasing option is 3,985,593. Both of these are negative. Why they are negative? We shall go for the lowest cost. Both of these are cost. So present value of leasing option is lower than present value of buying option. The prime company shall be recommended to take the machine on lease. Why is it so? Because the present value of leasing option is less than present value of buying option. As a next step, to practice further, you can go into the study hub and navigate to chapter 6, 3.2 decision making. There you've got an activity 6, which deals with lease or buy. Well, that's all for now. Wishing you all the best for your upcoming exam. This is your FM expert tutor, Rashaad Hussain, signing off. Thank you.